welcome to Street Check, the best podcast in the history of Cabot Wealth Network, which has been in business since 1970, bringing investment ideas, research, stock picks, etc. For more than 50 years. I am Chris Preston, editor-in-chief and chief analyst of Cabot Stock of the Week.
And I'm Brad Simmerman, the chief analyst of the Cabot Wealth Daily newsletter and the managing web editor. This week, we are going to talk about ethical investing, making moral choices when you're making investing choices as our main theme. But before we get to that, we will dive into our big three, the Fed meeting this week and the market's response. We're going to talk about the recent performance of a couple of IPOs and the ongoing labor strikes, specifically auto workers, SAG-AFTRA, and what that might mean for investors. But before we get there, Chris, this week you will be defending a take. Your take: seasonality is an excuse and not a reason. And you have 90 seconds. Go.
Okay, yeah. So we've talked about this a lot in the past. September, historically the worst month of the year for stocks, and we're seeing that play out again this month. But summer is also usually a downtime for stocks, and that was not the case this year. Usually, the theory is that with volume low, with Wall Street on their vacations, there's just not a whole lot of movement. Well, May through, or really June and July were huge months for the market this year. The S&P was up, more than 10%. And then by that same token, there's been plenty of Septembers where it's been a good time to be in the market. The historic average, it's the worst for the S&P. Well, the average is down like 1% or a little less than 1% historically, which means there's been plenty of years where it's been up. I think seasonality is a good way to brush off, like, hey, don't worry about it. September is always down for the market. It'll bounce back. And there may be some truth to that. But really, we're just in a traditional downturn for the market. Bull market starts, has a big upturn. We're up 20% plus the first half of the year. And now there's a flattening out. There's a tweet from Ryan Dietrich of Carson Research Group showing that we're in a normal pattern following the market being up more than 10% in the first half of the year, and that things should bounce back in the fourth quarter, not because of seasonality, but because of the usual pattern when bull markets get started.
All right.
Did I hit the post?
Nah, I give you a little bit longer, but you were.
I thought you were being a little generous, but yeah.
Yeah, the tough thing with relatively low data points. I mean, you think about seasonality in investing. Well, we've only had 50 Septembers since 1970, so it's naturally sort of a small data set. And then you also get into some of the gray area stuff that I think a lot of our conversation today will be circling around, which is like, okay, well, is there enough evidence of a trend or of a pattern to attribute anything to it? And then you start sort of looking at, all right, well, where do you draw the line, right? Like when is enough evidence enough? Would be sort of my takeaway. But yeah, I mean, like we've seen this year, the sell in May thing did not work at all. October traditionally, when we're talking seasonality, is a good month for bottoms. So
yeah.
Maybe we disprove it next month, or maybe we reinforce the seasonality talk next month and bottom.
The market did bottom last October, so it goes against my theory a little bit, but yeah.
But I do think that the larger takeaway is more don't rely on seasonality as a primary motivator for making a buy. It's identify good stocks, good investments, good opportunities, sort of regardless of season, which is the old adage, it's time in the market and not timing of the market. So long-term investors tend to outperform.
I'm not saying it's a total myth. There is something to Wall Street coming back from summer vacation and selling out of their laggards at the beginning of September. That's a thing. But even this month, it seems like that's not what that precipitated the recent drop off. It was the Fed, which we'll get to in a moment.
Yeah, and one thing that I had shared with you off pod when we were sort of preparing for this was there was an academic review or study of the performance of the funds that participate in window dressing, right, where you sell your losers at the end of the fourth quarter and then buy whatever the best performers are going into the new year so that you can appear to have been invested in these great performing stocks. And that found that there's no evidence that it materially impacts fund returns.
Right.
So I do think that there's data stacking up that supports your thesis there.
Yeah. Okay. Let's move on to the big three. Number one, as you mentioned, the Fed again. At some point, it seemed like we'd shaken them off of our shaking the dog off of biting our leg for a bit there in the summer, but it's back. It may not be the market boogeyman anymore, but it's at least like the Principal Rooney, the principal name in Ferris Bueller's Day Off. Yeah, just constantly throwing cold water and trying to thwart all the fun that everyone, market bulls at least, want to be having. Higher for longer, what Powell said. Market didn't like that one. Were there anything that surprised you in what Powell said, or that you think surprised investors? It seems like the higher for longer thing they didn't like, but was there anything that changed sort of the calculus for you on, what to expect from the Fed?
I was a little bit surprised that their high terminal rate is extending out as long as it is. So I've been saying higher for longer for as long as we've had this podcast, right? Like that's been my base case for the Fed and for what we should expect from them. But even I was a little bit surprised to see how high rates were extending further. One comment or one question that was brought up by a reporter for the Wall Street Journal was whether natural rates, so the sort of effective interest rate, the effective lending rate for the U.S. economy, it's not an explicit set rate. It's something that would be inferred from the prevailing rates that are available in the market, but that the Fed tries to model by through their Fed funds rate. I did see some interesting information that natural rate may be rising a little bit. So higher for longer, maybe higher for indefinitely. I don't necessarily think that we'll keep rates at 5% for the next decade, but we could certainly see a scenario where rates are in the 5+ range for the next 2 years, and then are 3% and change for the Fed funds rate, maybe going out the next 5 years after that. So I do think that it's even longer than sort of I was expecting or cautioning. I didn't really hear anything from Powell. He did make one comment that like the soft landing is not an explicit policy goal of the Fed, which is accurate, but I think it's certainly something that they would like to see. The other thing that I took away from the meeting was the emphasis they were placing on being able to take a cautionary stance. It does reiterate something that we had talked about a few months ago, which is like the idea that they feel like they may have done enough and they're going to be waiting to see how some of these data points trickle through. But other than being longer than I expected, there weren't a ton of surprises for me.
Yeah. And there's like a dot chart Fed forecasts. So it counts the number of votes the committee has, or projections the committee members have, comparing June to now. It was at 4.25% ish back in June for 2024, and now it's like an even split between right around 5.5% and 4.75%. So clearly that's where the higher for longer comes in. They're expecting things to stay closer to 5%, if not above it, for at least the next year or so, which is, disappointing, but maybe not all that unexpected. But the market, as I mentioned, didn't like it. It just it dipped to new lows. It exceeded the August low yesterday, although it's bounced back today. I think we talked about the possibility of new lows. We may not have hit, the temporary lows yet. It was sort of, we knew a breakout was coming one way or another with the way the market's just been in the same holding pattern for the last, month or so, and while it isn't fully broken out to the downside, it's possible that we may have a few more weeks of downs. I don't think we're going to, we're not going to go back into bear market territory, but I think the next leg up is our Mike Santolo's, Cabot growth investor and analyst and a great market timer. As he said, the next huge move is going to be up. New bear bull markets never just up and die, but that might just take longer now than we may have expected. In the next few weeks.
That was something that Cabot Money Club Nancy Zambell had written about very, very recently in response to the Fed headline. And the talking points from Powell is that it just looks like there's more chop on the horizon.
Yeah.
So we're going to keep the grind continues, but grind continues can still be part of the path towards new highs, which is, right. I think, what most of the bulls are banking on now is that, this is gonna be boring for a little bit longer. We'll see spiking volatility and then cratering volatility, and then we'll sort of just muddle our way through sort of a mucky market.
Yeah, and I'm surprised you didn't mention it, and I could just let it slide, but I'll go ahead and mention it. One of my takes is now wrong. One of my defended takes from earlier this year. I said there will not be any retreats of 5% or more in the S&P, and I was clinging to the fingernails on that one until yesterday. It's now, I think, 5.6% from the highs, or at least it was until today. So that's more hot sauce in my gullet for whenever we do or punish ourselves for our wrong takes.
But that's good context. We've been talking like we're talking about this market as if it's a catastrophe or
5.6%.
5%. All right. Yeah, we're off a little bit after a great start to the year.
more, admittedly, but also it had higher highs. It was above 30% through the first half of the year. It was like one of the best first half performances ever. So.
Yeah, and the underperformance is coming from the same place that the outperformance came from, which is the high price tech stocks. Nvidia's down almost 20% since it hit its all-time highs. I think last I checked, it was traded around 430 after breaking 500. Right now, let me see, 418.
Yeah,
is the last quote that I've got. 418 and change. In the last month, it's down 8%. Since the beginning of September, it's down 15%.
Yeah.
So the mega cap tech stocks giveth, and mega cap tech stocks taketh away is the story of what we're seeing right now. But the overall economy is still solid and is still strong. The Fed wouldn't be pricing in 5% terminal rates at the end of next year if the economy weren't strong. So exactly. I think as much as it's maybe a bad news for growth investors, it should be a reassuring data point for most investors. And one thing I would be remiss not to bring it up, did have a daily article about trying to divine sort of the Fed's intentions, looking at some of their at their summary of economic projections. The Fed has two big dials. They can change interest rate policy, or they can change their asset purchasing program, right? Quantitative easing or tightening. So those are their only two dials that they can really adjust. So what they'll do is adjust them, and then they look further down the food chain into data inputs for that. And one of those is employment, one of them is growth, one of them is core PCE inflation, right? So what you can try and do to determine whether the Fed thinks that they are winning the long game is you can look at some of those inputs and see how closely those match expectations. They publish that quarterly. They just published the summary of economic projections with their September meeting. It'll come again in December. But you can sort of check the Fed's math by looking into that if you're inclined to.
Right. Yeah. Okay. Let's move on to number 2 in the big 3. That is IPOs, which we did a deep dive on last week. We mentioned a lot of or several big name IPOs are coming down the pike, and just the IPO market picking up in general. While 2 of those have gone public, ARM Holdings and Instacart in the last week, both priced high, as big name companies tend to be. The hype fuels them to being priced at unsustainable levels. And sure enough, both have pulled back since their IPO, or since the end of their first day of trading, which is not anything new. So many companies have done this. Meta, Facebook back then, as we mentioned, was below its IPO price until like a year in, and it's been obviously one of the best stocks in the market. Any takeaway from the pullback, or just the normal cycle of IPOs, and exactly why we said don't invest in IPOs in their first 3 months?
Yeah, when we talked about it, I had made the case, or I had made my impression was the IPOs were well handled from a pricing and market mechanics standpoint. Goldman Sachs recently published some data from 5,000 IPOs over the last 25 years. They found that IPOs that rose 50% or more on the first day of trading were likely to be 5% higher after 3 months, whereas IPOs that ran up less than 50% on the first day of trading were likely to be up about 1% in the next 3 months. Both ARM and Instacart closed higher on the day, but neither ran up to those levels at all. So the fact that they're down 15% in the first week or in the first couple of weeks, depending on the name, is not a huge surprise. And I do think it validates what our big takeaway was, which is IPOs, maybe look for more mature competitors. And Goldman had some further data for that. They found that the two factors that were most likely to, or the two factors that were most likely to result in an IPO that's trading higher are 40% sales growth in years 2 and 3 and positive net income in the 8th quarter. So Goldman Sachs's data is essentially saying you can't even tell what's going to make for a successful IPO until 2 years in.
Right.
So go ahead.
No, and that doesn't mean you can't invest in them until 2 years in, but I think
that's gut check time is what that is.
Yeah, right. Yeah, I think you know what you have there after that amount of time. You could take a flyer on it. Say Instacart continues to fall the next 3 months. You could see the first round of earnings and say, oh, that looks pretty promising. Maybe it is 40% plus revenue growth. And you say, okay, I'm gonna buy it now, especially if it's been knocked back, the way it is at the moment. But sounds like you don't know for sure what you have until 2 years in. But doesn't mean you can't take a flyer on a couple of them until after 3 months or
even after a year. If you've got a year, so you've got 4 quarterly earnings reports that are all showing, let's say, 40 to 60% sales growth, it's like, okay, well, that should be a good validator or that should be a data point that you look to validate your thesis over whether it's good to invest in the IPO. I think that's probably the most useful takeaway that your average retail investor may be able to get from this, because like we talked about, most retail investors are not getting IPO shares. They're the ones that are left buying on the open market, and they're the ones that paid a 15% premium to what Instacart and what ARM are trading at now. It's not the institutional investors. They got their allocation on day one. So if you are a retail investor and you're looking to buy into a recent IPO, is it showing sales growth? Is it trending towards positive earnings if it's not recording them already? Right. I think that's those would be the 2 items on my checklist if I'm looking to buy something that's IPO'd in the last 2 years.
Right. Okay, let's move on to number 3 in the big 3. You mentioned several strikes. This is strike season. Apparently, United Auto Workers just went on strike against Ford, GM, and I can never remember. Stellantis.
They manufacture Chrysler, Jeep, Dodge.
Right. And then that's on top of SAG-AFTRA and the Actors Guild. Sorry, SAG is actors, on top of the writers' strike in Hollywood, which has been ongoing, and I haven't heard anything about there being an end in sight. But you had some data on that, on the latter, the writers' actors strike doing some damage to at least Warner Brothers, right?
Yeah, so the reason this is on the docket today is it was prompted by a couple of things. One, the Writers Guild has been in like 3 days straight of meetings. They seem to be generating some actual progress. Two, Warner Brothers Discovery came out and estimated that they would take a $300 to $500 million earnings hit due to the impact of the strike. The Writers Guild, I believe it was the Writers Guild president or one of the negotiating parties, responded essentially by saying, all we've been asking for would be the equivalent of $50 million. And you guys are taking a $500 million hit to avoid giving us $50 million. I do think the optics, I think broadly, at least in the US, we're becoming sort of more understanding of strikes. Like, life is hard. People deserve a fair shake. The big three automakers CEOs make on average more than 300 times the median pay of
That's the key.
their hourly employees. And, you know, but that's been known. That corporate pay discrepancy has been sort of known for, it's been at 300 plus for longer than a decade, I believe, is the average pay for a US CEO.
But people might not know exactly that it's that number, that high a number, until they see it, and how they see it is through these strikes, and so that garners more sympathy for the strikers.
And I do think that the economic impact of inflation is also sort of opening people's eyes up a little bit towards labor practices. It's much easier if you are. Let's go back 5 years. All right. So the economy's humming along. Interest rates are near zero. If you're an investor in Ford and you see that the auto workers are going on strike, you say, oh, that's going to hit the share price. That's going to be bad for it. Now, statistically, being subject to strikes is not actually that does not actually do that much damage to share prices. But you look at it now, it's like, all right, well, I might be struggling a little bit more because inflation's been at multi-decade highs for over a year. I'm feeling the pain of that. It's a lot easier for me to then look at the auto workers and say, oh man, if I'm feeling it and I'm doing great, they must really be feeling it. I'm sort of on the workers' side there. So I think that the overall environment is more accepting or more supportive of some of these labor actions, and then also just being able to see those numbers. I can't. Barra, I believe, is the CEO of GM, has had a 40% pay hike over the last, I think it was 4 years. It might have been a little bit longer than that. Whereas the auto workers had an average of a 6% pay hike. So everybody's looking around and saying, "Hey, that's maybe we should reapportion some of that to the labor class." And I do think that some of that is a big impetus with the writer's strike approaching resolution. Is Warner coming out and saying, "Hey, we lost 500 million due to these writers striking," and then the writers say, "Hey, you could have spent 50, and we wouldn't have had to do this at all." I think the rubber's hitting the road for some of these that I think is going to lead to positive resolutions for the labor organizations. That's my hope, at least.
Yeah, and just to tie a bow on it, just from an investing standpoint, would the strikes make you hesitant to invest in Ford, GM, or Warner Brothers? Warner Brothers, different situations further down the road where it's actually hitting their wallets in a much more profound way. Would it give you give you pause?
I think that'll be a good lead into our main theme, because I don't, from a fundamental standpoint, no. Right. The fact that they're subject,
and I'm just talking fundamentals in this case.
Yeah. The fact that they're subject to labor action, it doesn't necessarily give me pause, right? Like, I wouldn't not buy Starbucks because sometimes they've got union activity and they're suppressing it. Like, maybe don't buy Amazon because of it. If the executive response was overly harsh on labor, right, maybe that would give me an ethical reason to pause. But the big defining trends for the automakers are going to be the pivot to EV. It's not going to be how this labor action is resolved. That's the big driver for them. It's going to be electric vehicles. It's going to be that transition. You know, that's what's going to be the big driver for it.
Yeah. All right. You mentioned ethics. So that's going to be that's our theme for this week. We'll get to that in just a second. First, I wanted to mention, if you have any questions for us, please feel to email us at streetcheck@cabotwealth.com, streetcheck@cabotwealth.com. And as always, while you're here, give us a like, 5-star rating, subscribe. This is what keeps the podcast going. And like we said, we always say it's a free podcast. So okay, let's move on to our theme this week, which is ethics and investing. Can the two things intertwine? And you and I, maybe we're okay. So I brought this this idea to our Jacob Mintz, who is our options trading guru, runs our Cabot options trader service, and never short on opinions, and never shy about making them known. Actually, I think he heard us talking about this. We touched on it a couple of weeks ago on a podcast, and he made fun of us for, basically call us sissies for for not investing, or even having a moral concern with investing. But for me, that there are some places where I draw the line. Some people may not have a place where they draw the line. Your line may be different from mine. Some people may have a line that's even stricter than what mine would be. But you and I came up with 3 stocks apiece that have perfectly good looking charts and or fundamentals, good looking stocks that we would not invest in. Do you want me to kick off with mine?
I don't know. Do you want to have maybe a little bit of a deeper, more general conversation around where our sort of ethical lines are? Because the thing is, once you start drawing lines, where do you stop? Right? The tobacco is an easy one. Alcohol.
You're stepping on one of mine, but yeah, go ahead.
I won't go into company specifics, but all right. So tobacco seems like an easy one, right? People get lung cancer, they die. Cigarettes are addictive. The ability of tobacco companies to turn a profit is highly dependent upon the addictive nature of what they sell. Okay, well, what about Pepsi, right? Sugar is very addicting. We have an obesity epidemic in this country. I don't see a moral hazard in investing in Pepsi the way I might with investing in tobacco stocks. And then where it gets even more complicated is, okay, well, what about inputs? What about production inputs? Can I buy Apple if their suppliers are engaging in risky mining practices and employing children? It's a question of where do you draw the line. I don't necessarily know that I have a totally clear picture of where I draw the line ethically. I know I have some big picture ideas, but I'm curious, where is your threshold?
It's a feel thing with me. I would say I don't have, if it's a nuanced company, we can get into some of those nuances. Cigarette company, they just sell cigarettes, like that. Cigarettes equal bad for you. And, I guess a lot of times it just intertwines with what if I was a smoker growing up or now, I'm sure I wouldn't have the same feeling. I'd be like, I've been smoking for 20 years and I feel fine. I'd have a problem with it. But I'm not. So, and there are other, okay. So let me give a couple. So, okay. This leads right into my first.
Okay. Let's dive in.
Dick's Sporting Goods is not my pick. I go to Dick's all the time because my kids play, every sport under the sun. We go there to get equipment for them. I just bought running shoes from there. We go all the time. I love going to Dick's. I don't love that you can just walk in and buy guns easily there. I don't love that aspect of it. And, even walking by that section makes me, cringe a little bit at just seeing some of the guns that are on sale there, not just for, hunting rifles or whatever. That leads me to my first pick, Smith and Wesson, SWBI is the ticker symbol. It is up 42% year to date. It is up sharply in the last 2 weeks at a time when stocks have been backsliding. Expects 7.5% growth in the current fiscal year. It's fiscal year 2024. That's revenue growth. Positive EPS growth this year narrowly, and next year more so. But so again, this goes to my just personal experience. I have 2 young kids in school. My wife is a counselor at a high school, and every day in the back of my mind, and in my wife's certainly, you just wonder when if you're going to get that call.
Yeah.
That there's a shooter here, active shooter here. Unfortunately, that's just the reality here in America. And for that reason, I refuse to buy any gun stock. I know that Smith & Wesson sells hunting rifles too. I don't fault anyone for hunting. I've sort of went myself. I've never shot an animal. So, I'm also not a hunter. So it's easier for me to say, but that is one where I draw the line on a very good looking stock and say I refuse to buy that or any other gun stock.
That one I think that one's probably pretty easier to draw, maybe a bright line. Even me, I have been a sometimes gun owner, hunting licenses. I've got a hunting license. I've got archery tags, right? So I don't have an ethical problem taking an animal. I also see sort of the value in limited access to firearms, but where I am on board with you in avoiding it generally is just the marketing message that we see with a lot of the firearm companies, where they lean into like the masculinity and the man card stuff, and it's like, oh no, you have to look like a soldier. I'll share this here. I don't know. The joke I've seen on Twitter is all the people in the army gear cosplay referring to them as gravy seals because they tend to be thicker boys like myself. So, but like that thing, that performative masculinism, like I can't get behind that at all. When you've got that sort of fish rots from the head vibe in your marketing message, where it's like, hey, our core message has to be, you can't be a man unless you own an AR, or that's what's going to make you masculine. Like, all right, no, I can leave your industry alone for a couple of years until maybe your behavior gets better, regardless of how I feel about the performance of your rifles, right? Like that becomes sort of an easy stay away one for me. I totally get that. I think my first one is probably going to be similar to that. I'm going to go with Core Civic. Ticker symbol is CXW. This is another one where it's like, all right, putting aside the social considerations of whether or not you should be incarcerating people. Core Civic operates private prisons. Their profit margins improve the worse they treat prisoners. The more money they can save on a meal plan or something like that, the less staff they have to pay, the less trained staff they have to employ, because it doesn't hurt anybody that's a taxpayer, right? It hurts people that are incarcerated. The stock bottomed in April around $8.50 a share. It's up 17% year to date, 26% since it bottomed, trading at 10 times earnings. It looks like a strong chart, and I think both of these stocks tend to benefit in periods of high civil unrest and general social discomfort, right? People fly to go buy, people rush to the stores if they're afraid, or if they're afraid of guns being banned. People are more likely to invest in private prisons and in that type of company if there's a feeling that there's a lot of social unrest. So I think technically it looks strong, and it has for the last 5 months, but that one's just to stay away from me. I will not touch a private prison.
Yeah, that's a good one I hadn't even really thought of, but yeah, that's that sounds like one that I would we were probably aligned on. Okay, my number 2. Okay, so I'm cheating a bit here. I'm not saying the stock name. You mentioned cigarettes earlier. The only reason I'm not saying it is one of our analysts just mentioned a stock in this industry, prominent stock in this industry, not just mentioned, added the stock to his portfolio as a deep value play.
Mhm.
I'm sure he's a very good analyst. He's going to be right. Probably going to be right that it's a good time to buy because, part of the reason I didn't pick one specifically because none of the charts look good. Now they're all down year to date, and I think it's just a dying industry. I mean, you look at any movie now versus one in the 80s, 90s. Everyone is smoking in the 80s, 90s, 70s, 80s, 90s, even early 2000, any like detective movie.
Yeah.
And now that's pretty much been eradicated. And, while people still smoke cigarettes, obviously, it's not as prevalent as it used to be. And, of course, I do not fault anyone who still does it, but I choose not to. And I, know plenty of people who have had lung cancer. So I would not support any of those companies, even though that one of our analysts is recommending it as a value play. Again, if you want to make money and you don't have that line, if you're like Jacob, you don't have the ethical line, you may like the pick and want to invest in it, and you'll probably make money. But that's just not something I can get on board with.
Yeah. Yeah, I mean that's sort of the tough nature of this conversation is that where do you draw the line?
Yeah. Again, our email is streetcheck@cabotwealth.com. This is the first episode in a while where I think we might get some comments, and please feel free to send them to us.
I don't know that. I don't know. Yeah, I get like tobacco stocks. All right, well, can I concede the point that people will consume tobacco products as somebody that has consumed tobacco products in the past? That's like, all right, well, yeah, I can sort of concede that. And yes, they're making poor choices about their own health, but that's everyone's discretion to do
Right.
so.
And it's easier to do this one because it's kind of a dying industry. It's kind of makes it easier.
I also wonder if you might have a little bit of regional bias because I think the Northeast is pivoting. It tends to pivot more quickly in social directions.
Yeah, I grew up in Richmond, Virginia, which is
that's a
the
good point.
home of of all things tobacco. So certainly, but I haven't lived there in 20 years. So maybe if I still lived there, I'd have a different perspective. But I still would be opposed to it. But it wouldn't seem as much a dying industry as it is.
I guess my question then is like, all right, well, how much blame do we want to give tobacco companies for the crimes of 50 years ago? Where it's like, all right, well, 9 out of 10 doctors say you should smoke Camels. It's like, all right, well, that's BS and that's harmful and it's really bad for people. Is that a good parallel for what big oil did, which was develop the most accurate climate model that we have, say, hey, we're causing climate change, and then fund a ton of like doubt-provoking studies that don't actually disprove it. They're just like, hey, we don't know. Maybe it's plausible deniability.
Yeah. And I've recommended in Stock of the Week, I think my first stock when I took over a little over a year ago, this was based on a recommendation from one of our analysts, was Molson Coors.
Yeah.
Alcohol stock. It's beer. It's not like it's liquor. But alcohol is, you could argue, a bigger problem, especially when people get on the roads. So, I guess the difference is I drink alcohol occasionally and then do not smoke cigarettes. So again, it goes to my personal bias.
Yeah, that it does. Okay, so I'm a dad, you're a dad. If you had to, if your kids had to have one vice, alcoholism or smoking, I would go smoking, right?
Probably.
Like it feels like all of the sort of moral components of it feel to me like tobacco should have, if alcohol's got a green light, tobacco should too. What I would pin it on is these sort of active disinformation campaigns of big tobacco. I think that would be enough for me to say, okay, well, you guys have your
like
chance.
You said, doesn't really even exist as nearly to the degree it used to anymore.
No, but part of that's because of regulation. I mean, look at
Right.
what transpired in the 90s with like Joe Camel, where it's like, okay, well, we're selling cigarettes to kids.
Yep.
Criticize the product as much as you want, but that at least is not something that alcohol producing companies do. It's not like they're trying to hook kids young. I mean, maybe Zima.
Yeah. Does that exist anymore? It did when I was.
It does. It still does. I never drank it. The Smirnoff icing stuff, like maybe that
Oh,
appeals a
right.
little bit to kids.
Yeah.
But it's not a marketing message. I guess maybe what I'm framing it around is more moral alignment with executive choices,
Yeah.
right? Like both tobacco and alcohol are bad products, but in one instance, senior leadership is making ethical choices that acknowledge that it is a questionable product of limited actual value, but that people like and use.
Yeah.
So I think I am crystallizing around that a little bit.
Yeah. Let's get to
My
number two.
my number two, we've talked about it a little bit, is Fang. It's an oil stock.
Mhm.
Diamondback Energy. It's up 19% in the last year. It's trading at less than 8 times earnings with a 4.5% dividend yield. And they've been doing what a lot of the big explorers and producers are doing, which is minimizing capital expenditures and pushing cash out to shareholders. I believe this. I don't know if this is in a portfolio. I know it has been in some of the Cabot portfolios in the past, but as an industry, oil is one that I can't do it. I can't touch
Yep.
it.
Agreed. Yeah. And this is one that I have to in real time make this decision quite often running stock
Yeah.
of the week. So stock of the week, for those who aren't familiar, is every week I recommend a stock from among our 7 of our other Cabot newsletters. And several of those have energy stocks, especially lately with oil at $90 a barrel now. And I'll get to one, I'm like, yeah, that sounds great, but I can't do it. And yeah, I'm in the same boat as you. And what made you pick Diamondback Energy in particular? Just the chart?
Yeah, chart's good. Dividend yield is good. Their cash flow story is very good. So
Yeah.
one sort of wild card that I want to throw into the mix. Do you remember Engine Number One? I believe it was. It's a fund company. They got 3 seats on ExxonMobil's board of directors in 2021.
Yeah.
And what they are is they're an activist fund company, because one of the unfortunate realities is companies listen to their shareholders. So if you're not a shareholder, right, absent a ton of public pressure, you don't have a voice in the room.
Yeah.
So what Engine Number One did was they effectively said, hey, we're going to run an S&P 500 fund, but what we're going to do is we're going to align our share votes with this ethical position. I
Mm-hmm.
think if you are activist minded at all, or environmentally minded or ethically minded with how you do your investing, one alternative to just foregoing an industry entirely is to invest in it in a manner that allows your message to go through. So instead of just buying SPY and paying the bare minimum expense ratio, it might make more sense to buy a fund from an activist fund company like Engine Number One, where then you're still invested in oil, but you also have a seat at the table a little bit.
Right.
Uh,
Yeah, that makes sense. Yeah, and energy obviously is a very hard one for people. I'm guessing that most people listening to this, watching this, have oil companies
yeah.
in their portfolio, and rightly so. So how many people got Exxon stock from their grandparents, and that that sort of was their first dipping their toe into investing. It's a tough one to ignore.
The other aspect to it is we're coming at it from a little bit of a point of privilege globally, right? The U.S. Industrialized 70 years ago, right? We had essentially finished our industrialization, and we're just expanding at that point. 80 years, we'll say 80 years ago, post World War II. Much of the emerging economy, much of the emerging world did not.
Yeah.
So how can we be the beneficiaries of the high energy density of fossil fuels that allowed us to industrialize and grow and modernize, and then pull up the ladder behind us and
Right.
tell
Yeah.
all these
Yeah.
other emerging countries that don't have the infrastructure to build out solar or something like that, that they are no longer entitled to access the high energy density of fossil fuels. So there's a gray area there, but
You can simplify and just say, I'm not saying that those countries shouldn't do that, or that companies shouldn't be doing that. I just don't want to be part of it.
Just not willing to profit off of it.
Or profit off it. Yeah. Okay. We're running pretty long, so let's do our last ones fairly quickly. Mine, my number 3, I mentioned it earlier, Meta. It's up 150% year to date. So this qualifies as a very, it's obviously one of the market's great growth stocks. Struggled for a few years there, but it's back with a vengeance this year, like a lot of mega caps. Okay, so some of it's a Zuckerberg problem for me. I do not like him, but I also, our producer Sam mentioned she wouldn't invest in Tesla because she doesn't like Elon Musk. And that there's a lot of people that share that opinion. So I don't love Jeff Bezos. There's plenty of CEOs of these major companies that kind of make your skin crawl a little bit.
Yeah.
But it's not just that for me. It's the spread of disinformation. My answer would have been Twitter until Elon, who I just mentioned, took that private, because Twitter, I think, is just like, the deterioration of humanity, basically, with all the just gives everyone a platform to complain or ridicule, shame, bully. And Facebook is sort of the same way, but there's also the disinformation aspect. It's enough for me. This is a new one for me. I used Facebook. I had no problem with investing in Facebook, really, probably until the last few years, just the disinformation stuff. And, maybe when Zuckerberg started taking jujitsu or whatever he's doing, it might have been the final cherry on top. No, but anyway, it's a big tongue in cheek, me saying this one, because it's up 150%. But I'll put it this way: of the FANGs, of the mega cap stocks, that would be the last one I would invest in. And that's partly because I just don't like sort of what the company stands for.
Yeah, that sounds like you're sort of aligning with the sort of leadership values, because I could make a case that Amazon is just as bad, right, with their labor practices. I owned shares, or I owned options in FANG, or in Meta earlier this year. I don't have any compunction against investing in it. I think the online ecosystem is sort of just naturally structured in a way that benefits bad actors and amplifies the worst voices. I don't know that that's specifically Meta's fault. I know they certainly had a huge hand in making it that way, just with algorithmic choices early on. But that does not hit the tipping point quite for me.
Okay. What's your third then?
My third is American Eagle Outfitters. They are the apparel retailer that was one of the first to really lean into the fast fashion trend, where you're just producing a high quantity of really low quality goods. You sell them as cheap as possible. This is one that is sort of an easy choice for me because it's entirely voluntary. You can run a great apparel company and make durable products that last a lifetime, right? I mean, we not necessarily shoes, but certainly there are leather goods. My wife has Coach purses that will last 15 or 20 years. And the problem with the fast fashion thing is, it used to be you could get a pair of pants and you could repair a tear, or you could do whatever. Now it just gets donated. Okay, well, people used to be able to wear those Now it just gets shredded to rags in like Ghana, where they're just getting all this excess fabric. And it's like, all right, well, we're trying to build an economy off of this. And you've stripped so much quality and value and material out of the products that you're selling that they're not even repurposable any longer. And that's entirely a choice. They could charge a little bit more for a higher quality product, and it wouldn't contribute to things like microplastics in the ocean, microfibers in, you know, human tissue, stuff like that. So the fast fashion guys, I'm total stay away from me. You can have the best shoe in the world or the best t-shirt in the world, but if you're contributing to the fast fashion ecosystem, I'm out.
Yeah, that's a deeper pull than I didn't see American Eagle coming, but that's a good one. Yeah, I mean, there's, you know, people may vehemently disagree with all of these. Again, your line may be different, or you may not have that line, and that's all fine, but those are ours, and we've been talking about it for a while now. I think we need to get out of here. Any last words, other than, again, leave a comment or email us at streetcheck@cabotwealth.com if you disagree or agree with us.
Yeah, I would just say, to put a bow on the ethical thing, if you draw a line, don't invest. If you are worried that you're missing out on a profit, look at an alternative. Maybe there's an engine number one way for you to get involved with some of these companies that you disagree with. But also, your own personal ethical line is not going to match everybody else's, and it doesn't have to. Just give it some thought.
Yeah, and my point is, there are a lot of companies out there, a lot of sectors out there. You can make money even if you avoid a select few based on ethics and morality. Anyway,
definitely.
Okay, well, let's both step off our soapboxes and sign off. Thanks for joining us on Street Check, and we'll be back next Friday.